market movers. This is The Pulse with Francine Lacqua.
Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London. Now, in just a moment, we're joined by George Saravelos from Deutsche Bank to discuss inflation, of course, what that means for FX and especially dollar. But we also have a Bloomberg scoop on Samsung on a potential U.S. listing. So we'll get to that. But first, U.S. military says it has completed another series of strikes on Iran and will resume a naval blockade later today. Well, Jeff Mason, Bloomberg's White House correspondent, asked the president in the Oval Office about the military escalation.
Mr. President, just on Iran, you have said now to Congress that we are back at war. How long do you expect this to take, and what's the legal basis?
Take what?
The war.
Well, I think it's going very fast. We had a deal yesterday or the day before yesterday. It was all done, and then they broke up that deal immediately. We're not going to put up with it.
Well, let's bring in Abir Abu Omar, Bloomberg Horizon's Middle East anchor. Hi, Abir. So what do we actually know about the latest strikes, and what's different about the U.S. strategy in the Strait of Hormuz?
Good morning, Francine. We're seeing a continuation in the region from these tit-for-tat strikes between the U.S. and Iran. This morning, in the early hours, here in the Middle East, the U.S. Central Command saying that it finalized a third consecutive night of attacks in Iran. Some of those southern provinces were hit. You're seeing now the pictures of Bandar Abbas being hit, a port city. Iran striking back against targets in the region that includes GCC countries, namely Jordan, Bahrain, Kuwait, Qatar, and it also hit 2 UAE ships in the Strait of Hormuz yesterday, resulting in the death of one person, 8 other people injured. So you're seeing this escalation in the rhetoric, especially over the past couple of days. Now, that already started at the beginning of last week, Francine, when Iran started by hitting an LNG-laden ship in the Strait of Hormuz, flagged to Qatar, the U.S. striking back against Iran, and then President Trump at the NATO summit saying that as far as he's concerned, the ceasefire talks are over. Now, just at the top of this segment, you heard him saying that the U.S. will strike Iran very hard, but then towards the end of that, he did say that the technical talks could continue and we could still see a result in all of this. Now, just to be sure, we're not clear on whether these technical talks between the U.S. and Iran are set to continue. We expect a continuation. We don't yet expect a full return to a full-fledged war similar to what we saw in March, but the complication in the region is prevalent this morning, especially in the Strait of Hormuz. What's different this time around is that the U.S. came out and said, or President Trump came out and said, that a 20% fee on tankers would be implemented. That would amount to about $30 million per very large crude tanker, Francine, at the current oil prices. So you're seeing Brent crude really reacting very quickly to this news, $85 on the barrel. That is the highest level that we've seen in about a month. We still continue to see or monitor the movement in the Strait of Hormuz that seems to be, at least for the time being, at a standstill, with a lot of ships deciding to go through either dark or hold still for the time being.
Abir, thanks so much. Abir Abu Omar there in Dubai. Now, traders ramping up bets on a July Fed rate hike as oil advances for a second day. The dollar easing this morning ahead of U.S. inflation data and, of course, Fed Chair Kevin Warsh's appearance later today. Now, the Fed Governor Christopher Waller signaled that further rate hikes may be needed to tame rising prices.
If we get another hot reading on core inflation this week, then the FOMC will need to consider tightening monetary policy in the near term. As always, we need to avoid making the mistake of fighting the last war and reacting too soon to tighten inflation.
Now we're joined by George Saravelos, Global Head of FX Research at Deutsche Bank. George, thank you so much for joining us. What actually is driving FX? Because you have this renewed concern about the Middle East. You have AI valuations. I mean, you have a lot of data in the U.S., but you think it's yield that's kind of the common thread.
As you say, there's so many things that have happened this year, but the remarkable thing in FX is just how low volatility has been, and as a result, carry trades have done the best. If you're a high-yielding currency, you've outperformed the low-yielders. And I think underpinning that is this global growth resilience, which we've seen despite all these shocks. Now we're seeing another shock out of Iran. But globally, if you look at where global growth expectations are, compare them to the start of the year, they're actually pretty similar.
Is that worrying because something will happen that, are we seeing dislocations that point to something a little bit more severe?
I think what's worrying is that there is a certain extent of positioning in the market on risky assets, whether it's in equities, in FX it's mostly expressed as carry trades. But at the same time, what's actually fairly reassuring is the fact that despite all these shocks, global growth is holding in very well. And I think there's two reasons behind that. Fiscal policy remains very activist globally. In the US, we had OBA. Even in Europe, you had some fiscal easing. In Asia, you had price caps for consumers, so they don't see the oil price increase. And of course, the AI story, which is leading to these big upgrades in Asia growth. And that's offsetting the oil shock to some extent.
So, George, talk to me about dollar. So, dollar, has a lot of things going on for it. Like, what's your target for here until the end of the year?
Well, I think, as you said, there's so many things going on, and to some extent, they're offsetting. So, you've obviously seen the Fed repricing, but we've seen global central bank repricing as well. So, if you look at relative rate differentials, they've not moved all that much. The global growth environment has been a negative for the dollar because it's supporting all these high yielders. And then, on the other hand, of course, you have this debate around the Fed. So at the moment, we think the dollar is relatively fairly valued. Against the low yielders, probably you can see more dollar strength if the Fed does go on these hikes. But I think the key question for me for the dollar is, does the Fed only do these 2 hikes? Is it a tweak? Or are we going back into full-fledged hiking cycle where we're talking about 100 basis points, potentially even more? And that would be a much more dollar bullish environment. So we're definitely on the lookout for that. I think the CPI number today, as Governor Waller said, is going to be very important. And we see how Fed policy evolves.
I mean, what are you expecting from Chair Warsh?
Well, I think at the moment our baseline is 2 rate hikes for the rest of the year, so a recalibration. We'll see what he says this afternoon. I think when he was in Sintra, we saw he actually didn't say all that much, kind of staying faithful.
He was good. It was diplomatic.
Staying faithful to this mantra of not much forward guidance. But then we see Governor Waller saying how much the Fed could react to one data point. So I think there's still quite a lot of uncertainty. Baseline is he doesn't provide that much guidance as far as July goes. And I think the market is much more likely to react to the CPI rather than what he says.
George, I mean, I'm looking at headlines, and they came in a couple of hours ago saying, 2 UAE tankers were attacked, and of course this brings fresh risk to flows from Hormuz. But how's it possible that we're not really seeing anywhere else, apart from the price of oil, certain days?
So I think the key question from a market perspective is how many ships go through that strait. At the end of the day, it just boils down to that transit route. And even as of Saturday, there was a news flow of around 20 ships going through. Of course, now it's very likely that goes back down again. If it remains closed for the next couple of months and there's nothing going through, I think the oil price will go back up. But things move so quickly that every other week, I think the market is taking some statements with a pinch of salt in terms of how long the duration of this re-escalation lasts.
And George, I mean, it's clearly the Asian economies that suffer the most because of higher energy prices. Does that have a direct impact on their currencies?
Well, it's interesting because they suffer the most, but they've also been the biggest beneficiaries of the AI, let's call it revolution. And I think especially currencies like Korea, Taiwan. For example, if you look at central bank pricing for Korea, you're now pricing an incredibly hawkish Bank of Korea, and rates in Korea are almost as high, or actually even higher than the US. So effectively, these two forces have offset the AI against the oil shock. And I think if you're looking forward, it's probably more likely the AI shock dominates in the medium term.
I mean, how do you look at AI? Because we haven't really seen any kind of real-world application for transformation of the economy, but we know it's coming.
So with AI, we published a big report where we separated it into 2 parts if you're trying to analyze the macro impact. The first part, which we're living through now, is the CapEx build-out. Yeah. And here it's a lot more about the production of the chips, the digging of the holes for the data centers. And the clearest beneficiaries are things like NVIDIA, the Asia economies that are producing the chips. The second part is once you've built the data centers, who's the beneficiary of the revenue? And here, the clear answer is the US with the hyperscalers. I think there's a very big debate in terms of the frontier models versus the models produced out of Asia. But from a currency perspective, the biggest impact is going to be seen, I think, when the models roll out and the revenue starts streaming in terms of the dollar. The question is, are equity valuations at the moment reflective of the expected revenue? And I think we're at a stage where risks are fairly two-sided, where the market does worry about excessive valuations, and if revenues end up disappointing, that could end up being a negative for the dollar at this stage of the cycle. Second part of the cycle, a bit further out.
And so further out, and this is when we start looking at productivity and also job losses.
Productivity, job losses, the revenue that's being generated, the deployment, the full-fledged deployment of AI in the economy. And I think the market has some very optimistic projections in terms of rollout. We do read quite a few stories in terms of restrictions, whether regulatory restrictions, the cost of tokens. But I'd say the bigger picture question mark on AI or observation is the market really struggles to see around the corner. There is a lot of information asymmetry. So 6 months ago, very few people were talking about the memory surge. You've got companies, if you take Japan's largest company now, which has exceeded Toyota market cap, 6 months ago, it was one of the smallest companies. So things are changing very, very rapidly. And I think the market is learning by doing, so to speak.
George, what's your take on yen? And then we'll get on to sterling.
Well, we have fresh headlines again with the government trying, I think, to manage yields down in terms of these discussions around potentially repatriating money back. Or potentially shifting money from onshore deposits to JGBs. So there was reporting today that they may be considering tax-free treatment of Japanese government bonds. I think all of these should end up being positive for the yen, but the market is very doubtful because historically there's been a lot of jawboning, but in terms of action, it's been quite slow. So we're waiting to see for more specifics and timelines in terms of these policy shifts. But I think if we were to see stronger indications of, for example, the GPIF changing allocation, that would really be a very positive thing for the yen.
And sterling, I mean, it's half. Of course, we're looking at the BOE. Andrew Bailey was also very careful in Sintra, but it's also a politics story.
Absolutely, and we're going to have a new Prime Minister. I think few would have thought a few months ago that if we're in the run-up to a new premiership with Andy Burnham that would be seeing sterling actually outperform so much. I think the reason is the market was pricing a lot of risk premium into the event. And if you look at a lot of the headlines and the news flows that's come out, effectively the market is hearing what it wanted to hear. So, for example, there's now a discussion of bringing forward the spending review, which was due next year, into a budget event in October, which will provide much more flexibility, it will provide transparency and clarity. So in that sense, the market's bringing down the fiscal risk premium, and that's why sterling's doing well. We have had that view that sterling could outperform, but I think now we've priced a lot of good news. So it's going to be a question of delivery.
So what happens next, George? As always, thanks so much for joining us. George Saravelos, they're Global Head of FX Research at Deutsche Bank. Now, Bloomberg has also learned that Samsung is in the early stages of exploring a potential U.S. share sale. Now, for more on our scoop, we're joined by Matt Bloxham, Senior Analyst at Bloomberg Intelligence. Matt, good morning. So why might Samsung be pursuing this sale?
Yeah, good morning. I mean, a couple of reasons here. I think probably most importantly that it opens up the huge investor base in the US, many of whom either won't be able to directly invest in the stock locally or struggle to and just kind of get put off by the implications. And as we saw with SK Hynix last week, there's a huge amount of pent-up demand for anything to do with the kind of AI trade, and I think in particular kind of with the memory stock. So that would be the kind of most important aspect. But obviously also, SK Hynix raised over $26 billion from that issuance last week, and Samsung's a big company, but if you can kind of raise capital cheaply to kind of fuel the next round of investments, then that's also a good opportunity for them.
So, Matt, does this mean more market volatility as a result?
I mean, I think it certainly could do. We've seen that also with SK Hynix. Obviously, there's a lot of interesting conversations, analysis around there about these leveraged ETFs that are sparking up. And certainly there's, a lot of excitement in the US market that the SK Hynix ADR and potentially a Samsung ADR kind of create new opportunities for US leveraged ETFs. And that inevitably creates volatility. And, we've seen that very clearly in the Korean indexes in the last couple of weeks because there's so many leveraged ETFs there already.
Matt, thank you so much, as ever, for joining us. Matt Bloxham, there, Senior Analyst at Bloomberg Intelligence. Now, coming up, Wall Street's trading bonanza is poised to keep rolling. The biggest U.S. banks are set to kick off earnings season with results later today. Of course, we'll have your preview next, and this is Bloomberg. The conversations that matter, the insights you need. This is The Pulse, and I'm Francine Lacqua here in London. Now, 5 major Wall Street banks report later today, kicking off earnings season with a bang. A global surge in deals and IPOs is expected to drive blockbuster results as volatility from the ongoing US-Iran conflict, of course, fuels equity trading revenues. Well, we're now joined by Tom Metcalf, Bloomberg's EMEA Finance Managing Editor, and Paul Davies, who covers banking and finance for Bloomberg Opinion. So thank you both for joining us. I mean, it's a big day, right? So then we can relax with a bit of football afterwards, relax or not relax so much. Profits high, regulators easing rules. Like, what are you expecting from the big banks?
We're expecting some really big numbers. We're expecting a lot of some very high revenues reported from the markets desks, and obviously, investment banking fees also looking incredibly strong. I mean, some of it will be a touchdown on the first quarter, but people are already saying for the year as a whole, we're going to have record M&A volumes beating 2021, record IPO proceeds beating 2021. And that's still with, a lot of deals aren't running at as high a level as they have done in previous booms. They're still kind of, when you compare it to sort of stock market capitalization or GDP, the volume of deals being announced is still sort of below the 20-year average. And IPOs, we're still missing, a lot of private equity exits. We're still missing that huge SPAC boom that we had in 2021. There's still more that could come out of this, I think, is the message.
Tom, what are you looking for? I mean, again, it's also great insight into AI, how they use AI, thoughts on, we'll hear from some of the chief executives on how they see this going forward, but also, I guess, the health of the U.S. consumer.
Yeah, absolutely. And, be interested to see how they say those retail customers are doing. And look, even whenever there's been sort of widespread turmoil in the world, the American consumer, as broadly speaking, at least as the banks see it through their window, they're often just saying, we're not seeing any signs of distress within that particular cohort. And obviously that doesn't probably include, the absolute lowest income people who are really struggling in many economies. But yeah, that will be the other side of the coin. Capital market business is booming. You suspect that's also going to be supported, on the retail side, obviously with interest rates staying higher. That's, broadly speaking, should still be good news for banks. But if that starts to inject pain into the consumer side of things, that could be more of a cause for worry. So
what can we expect in terms of dividends and buybacks?
So we've already had a round of kind of dividend increases announced, sort of just after the stress test results this year. I mean, I think one of the interesting things now is, profits are so high, banks already were sat on an awful lot of spare capital. There's more regulatory reform and kind of rule easing coming down the pipe. Yeah. So the question is, what do they do with all of this spare money? I think we've already had something like over $100 billion worth of stock buybacks from the big 6 banks so far this year. As I say, they've already upped dividends after the stress test. And the next thing is, well, how much of it do they invest in growing their balance sheets? Goldman Sachs kind of led the way in the first quarter by really expanding prime brokerage, lending into M&A deals. And I'd be looking closely to see how much some of the other banks follow that and really start deploying more capital into markets and deals.
If you're a bank CEO today in the U.S., what do you actually worry about? Is it geopolitics? Is it AI? Or is it just the uncertainty of it all?
Yeah, probably the bubble, right? But there's been no sign of that actually starting to really hit. And obviously Iran's going sideways again. But again, there just seems to be this ability for markets and the consumers with that disposable income to just look by that. And so broadly speaking, as Paul's saying, I'm expecting actually very positive soundings, the usual warnings, but no sort of real pain points yet.
What should we make of private credit? Because I get so much pushback from, the private equity people, but also some of the banks. When you talk about risk in private credit, should we really worry about it, or should we worry about it, but it's like a sideshow?
It's kind of, it's a story of two investors still at the moment. I think on the one hand, you've got these retail sort of wealth individual investors who have been pulling money out a lot of the big funds. Yeah. And if you listen to them, a lot of them are saying this is coming out in Asia much more than in Europe and certainly than the US. And on the other side, you've got institutional investors who seem to keep ploughing more and more money in. And the fact that there has been some, credit concerns and some liquidity issues, and that has kind of led to a bit of spread widening, that's drawn some of the institutional investors back in a bit more as well. So, we've got to look closely for more credit deterioration, and there will be more of that, but exactly what investors do, how they react to that is still kind of to be seen, I suppose.
Tom, I know it's a difficult question because the earnings are out later, but if you're to look at the 5 banks, or actually all the big Wall Street banks, who's coming up trumps? I mean, it feels like Jamie Dimon with Fortress Diamond, one of the biggest bank in the world, but Citigroup's also doing great.
Yeah, I'll be actually really interested to see how they do this quarter. Obviously, there's that turnaround story under Jane Fraser. And talking of deal making, they are making that big push, that big build out. So it'll be interesting to see if that's, reflected again in the numbers or what they're saying. I just think every bank has a really interesting story. I mean, look, if Goldman's stock traders again beat that record in this quarter, that will really jump out. But that's the funny thing. You've got 5 of these big banks reporting, so it's actually going to be quite difficult for them to cut through. So I'd probably put my money on a JP Morgan or Goldman just because they tend to sort of resonate most on the street.
I mean, if you're part of, some of these subscribers of some of these massive IPOs, does it reflect already in the numbers now? Or it's maybe a bit too soon?
So the SpaceX IPO, the fees for that will be in because that's listed. So that's $500 million between, well, I don't know, almost every bank you can think of, but with a few big leaders. The M&A, we're talking about announced deals. The fees that they're collecting now are deals that have closed in this quarter, so they would have been, historical. But then we've got like a bunch more IPOs supposedly coming up. Anthropic, OpenAI, companies like this who are also going to be like, great beasts bringing in lots more fees.
Are they a game changer actually for the banks, or does it just attract in some of the smaller IPOs?
I guess there's still a bit of a debate about the extent to which the scale of these IPOs sucks money out of other possibilities. If SpaceX had gone incredibly badly, then OpenAI and Anthropic would not be getting done at all. I think it's still doing okay, so there's still sort of profits to be recycled into new deals. But, there's only so much equity money to suck into new IPOs. So, if all of these big deals keep coming, then some of the smaller possibilities, might not make it.
Tom, the real biggest story of the day is that with 5 bank earnings, Mike Mayo has to skip the gym. So you're going to cruise, right? Because Paul cruises. He looks at everything and then he writes 1 or 2 columns. How's your team going to do it? Because some of these earning reports are also like hundreds of pages and they come at you at once.
Yeah, it's going to be an extraordinary day just purely from a coverage point, whether you're an analyst or a lowly journalist like Paul and myself. But, that's the practicalities of it. And that will be sort of, where, you kind of deploy that big team, you have all that technology to sort of try and help pass those things. I do think it'll be a really interesting test because sometimes you see, kind of the sort of the big stories seemingly going in one direction for shares, but actually the market starts to respond to something else. No gym for anyone today, I suspect.
No gym, football later, and then we'll get them back on tomorrow to see if they survived. Tom Metcalf, Bloomberg's EMEA Finance Managing Editor, and Paul Davies from Bloomberg Opinion. Now, this is a picture for, there's one thing that we can't ignore is, of course, what's happening in the Middle East. So if you look at U.S. futures, they're pretty much down, but actually they're a little bit more stable than maybe we thought they would be this time yesterday, given everything that's going on, which is not only the Strait of Hormuz, but also we have the Kevin Warsh testimony, and then, of course, you have CPI later. Coming up, we'll discuss the outlook for the UK economy as Andy Burnham prepares to become the next Prime Minister. We'll have full details of that next, and this is Bloomberg. Good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London, and these are your top stories. President Trump says the U.S. will become, quote, guardian of the Strait of Hormuz after completing a fresh round of strikes on Iran. Bloomberg learns that Samsung is in the early stages of exploring a potential U.S. listing after SK Hynix raised $26.5 billion last week. Plus, Wall Street's trading bonanza is set to generate almost $39 billion of revenue. Five of the biggest banks report earnings later today. Now, traders also boosting bets on a July interest rate hike driven by a renewed rise in oil prices and, of course, hawkish commentary from Fed officials. Now, upcoming U.S. inflation data, but also a Federal Reserve Chair appearance are set to further test market conviction. We're joined by Ven Ram, Bloomberg and Life strategist for currency and rates. Ven, it's quite an exciting day. I mean, it's CPI plus testimony. What are traders ramping up, or why are traders ramping up bets for a July hike from the Fed?
Morning, Francine. I mean, it's an absolute mayhem in the bond markets today, with bonds selling off across the board, except in JGBs. But I think that, with the CPI report that you mentioned, the markets are expecting a core inflation reading of 2.8% and a headline inflation reading of 3.8%. If those readings are anywhere near what they expected to be, I think that it will add pressure on the Fed to raise rates, because by the Fed's own projections, the economy is supposed to grow about 2.3% this year, and core PCE is going to be about 3.3%. So you're talking about nominal growth of well above 5%. So when your nominal growth is as much, it's not appropriate for the Fed's benchmark rate to be at 3.75, and therefore the markets are sensing the pressure that, look, the Fed will have to raise rates, and that's what we are seeing in the markets.
I mean, it cast me back to Sintra, where all the central bankers gave us a masterclass in saying as little as possible because they don't want to talk about forward guidance. European bond yield soaring today. What's the outlook for the ECB and the BOE?
Well, I think the ECB is on track to raise rates at least once more in the remainder of the year. I think that with them already having raised in June, I think the immediacy of the next hike is not in question. They're going to meet next week, but no one expects them to raise rates. But it's a different question for the Bank of England. They haven't raised rates in response to the Iran war yet. And I think that, the inflationary pressures that are building up are unmistakable. If you look at gilts, they are underperforming the rest of the global complex, suggesting that the markets fear that, the inflationary impact of the war is going to be felt very acutely in the UK. And I think that the markets are therefore pricing 2 rate hikes from the Bank of England. Whether or not the Bank of England will deliver those on those expectations remains to be seen, Francine.
Ven, thank you so much. As ever, Bloomberg M Live strategist Ven Ram. Now, as we've just heard, traders also boosting wagers on Bank of England rate hikes. It comes as UK Chancellor Rachel Reeves is expected to tell a City of London audience tonight that plans to boost the economy will only work with the support of financial markets. Now, her speech at the annual Mansion House dinner is likely to be seen as a warning to Andy Burnham, who is set to become Prime Minister next week and is widely expected to name a new Chancellor. Now, we're joined by Bruna, Morgan Stanley's chief UK economist, and ALdrick, who covers the UK economy for Bloomberg. So thank you both for joining us. Phil, first of all, is there a chance that actually Rachel Reeves stays as Chancellor, or like 0.01?
Yeah, it's a very slim, very slim chance. I mean, she is going to be telling us about her achievements today at the Mansion House, and I guess that is an attempt to convince Andy Burnham that she should remain as Chancellor, but it looks like it's set that she's going to be moving jobs.
And Bruna, I mean, this is a very difficult time to inherit this economy, because if you look back, even Keir Starmer, and we won't talk politics, but there wasn't a real crisis. It's just that it was more of a temperament concern. So is this really an opportunity for Andy Burnham to change the economy? Like, what does this economy need to see growth?
Sure. So I think with respect to, as you point out, the problems that are brewing, and as Vem suggested, the immediate issue is that we are on course to see inflation in UK back at 3%, probably as early as July. Whether it accelerates beyond 3% or it stays there for the foreseeable, so for about 6 to 9 months, depends, of course, with what happens with oil and gas prices. So I think the immediate question is one of those inflationary pressures. Is there anything that fiscal and regulatory policy can do to help the Bank of England? And with less tightening in financial conditions, the Bank of England can actually take care of near-term growth as well. The question of potential GDP growth and medium-term plans is then something perhaps that can be ironed out in the budget, perhaps in October or November. I'm sure we'll find out shortly.
Yeah, and there's talk about them, the new Prime Minister announcing something a little bit bigger in the autumn. But what did Rachel Reeves get right on the economy?
So she inherited a pretty dismal fiscal situation, so she did have to fix that. And we did have, people may forget, but we had the jails, the prisoners were being released early to make space in jails for new inmates, and the NHS was on its knees. So there was a desperate need to raise revenue or to raise money for funding public services, and that was necessary. She raised about nearly 70 billion in tax. She borrowed about 30 to 40 billion. But the problem was that she arguably raised the wrong tax. The jobs tax was inflationary. It caused unemployment. It was definitely anti-growth alongside the national living wage. That put pressure on businesses as well. And so they weren't in the driving seat. So we basically lost a year. Burnham obviously is now going to inherit a much more stable fiscal situation. So he won't have to do as much hard work as she had to do. But there is a sort of sting in the tail because she left quite a lot of the hard work to the end of the Parliament. So there's tax rises coming, which Burnham's team will have to deliver because that's one of her legacies.
But Phil, I mean, if you look at Rachel Reeves, I mean, or Keir Starmer was the most difficult thing actually keeping the party together. And is that why these budgets kind of had a bit of everything for everyone, which means that at the end of the day you weren't really sure what you were looking at?
Yeah, I think the sort of defining moment of the political instability in having its impact on the economic situation was the planned welfare reforms at the spring statement in last year, where there was this enormous backbench rebellion, and rather than make it a confidence vote or try and assert power and discipline over the party, the government had to cave, and at that point, the markets were sent a clear message that the government, despite its enormous majority, didn't seem to have control of the policy levers, and we, with the thin headroom, with rising inflation caused by the jobs tax, and then the lack of sort of ability to grasp the situation at the centre. All of that led to higher borrowing costs. Just the lack of faith in UK policy setting.
And Bruna, I mean, overall, and we were hearing from Andrew Bailey at Sintra, where he kept on repeating that they started the year thinking they would lower interest rates. I mean, it must be very frustrating for a central banker to kind of have what he thinks a plan, and then just because of the Middle East war, everything changes.
Depends. It is very difficult to operate in this uncertain macroeconomic outlook. I do think it's interesting and important for the BOE to highlight that the inflation data we're getting, March, April, May numbers, they were very, I would say, constructive in terms of the underlying inflationary picture. Sure, they're still above target, but about 80 to 90 basis points of that is motor fuel and heating fuel. So it is important to highlight that, look, the idea that we had in February, which is that underlying inflationary pressures are subsiding and then we can deliver rate cuts, okay, that has actually proven to be accurate. Now we just have to wait out to see how energy inflation pans out, or rather get some more confidence around it before acting next. So I do think that was a very interesting and I think an important message to highlight, and I expect we'll hear more from Bailey on that in the coming weeks.
But does Governor Bailey need to wait to find out basically what Andy Burnham will do with the economy?
I mean, you would expect that there is a little bit more coordination between the Bank of England and the Treasury, albeit the bank always takes Treasury announcements as they're announced officially. Having said that, by the time we get to the budget in October and November, surely we'll have a little bit more confidence around where oil prices will end the year. We'll probably find out what Low Pay Commission, for example, recommends for national living wage in September as well. And so I do think the bank will have a decent steer where the economy will go in 2027. And then, of course, you do get a little bit more information at the budget as well, and you can obviously provide the steer to the market at the end of the year too. So I don't necessarily think they need to wait for all the details, but it is an important input into their thinking. Yeah.
Phil, how quickly do you think we'll get a new chancellor? Quickly.
maybe we'll know this weekend. I mean, Burnham becomes Prime Minister on the 20th of July. I mean, assuming that it all goes ahead. So we ought to know before then. I mean, it's fairly imminent. Well, I mean, he has. What's happening in the markets right now with caused by the Strait of Hormuz situation is a reminder that every leader of the UK seems to be damned with some kind of tragedy or some awful situation that they have to address. And Burnham for a while was looking like he was going to be coming in with interest rates beginning to look like there's a possibility of cuts and you get the near-term growth or whatever. Now there's 2 rate hikes priced in by the end of this year again. So he's facing a difficult situation.
It is a difficult situation. I just wonder whether a central bank kind of waits, because we don't really know what happens with the Strait of Hormuz, and it seems to be changing by the hour. So is there a point in just waiting to see how this develops until, October, November?
I think you can't wait forever, right? We saw that in 2021 and 2022, right? At some point, you need to have an idea where the economy will go at the time when you're setting policy, which is about 18 months to 2 years. Having said that, you referenced Sintra, and I thought one of the big messages from those meetings was essentially we don't need to tell the market where interest rates are going to go next week, next month, etc., but we need to provide a clear framework as to how we operate and how we think about uncertainty. In April, the Bank of England provided that framework within the scenario analysis that they put forward. And if you actually look at oil prices, they're still running quite close to the most benign scenario, which is pretty remarkable given what's happening with the repricing in the front end. And so I think that's what I'm quite interested in hearing from Governor Bailey, perhaps in the coming days, maybe closer to the July meeting. Is that framework from April still valid? And if so, I don't necessarily think we'll be seeing near-term rate hikes. So the reinforcement of that framework of those scenarios, I think, would be very, very helpful for the market.
And Phil, in terms of financial stability, so we're expecting Rachel Reeves to talk about ring-fencing reforms. We heard from Sarah Breeden. I mean, in Sintra, she talked about AI concerns, and then there was a report last week. Like, what are you looking out for banks?
So I think she's going to be pushing on gradually with these ring fencing and trying to provide a sort of capital arrangements so that banks can increase the supply of credit to the economy, all these efforts to just boost growth. And on AI, I think the government is trying to look at it as a positive opportunity rather than, obviously, Sarah Breeden's concerned about the potential bubble risks and other risks. But, can we use AI to stimulate the productivity miracle again that we've been lacking? So I think that's going to be part of AI skills, that kind of stuff.
And we don't really have an insight into what the next government wants to do, right, with the banks.
With the commercial banks?
Yeah.
No, there's not been anything. I mean, inevitably the bank tax always comes up, and so far the banks have escaped that. So maybe they will continue to escape that.
There's always talk. Thank you so much, both of you, for joining us. Bruna Skarica, Morgan Stanley's chief UK economist, and Phil ALdrick, our senior reporter for the UK economy. Now, Watches of Switzerland is in the spotlight this morning, both for its earnings as well as a potential takeover. Now, the top Rolex seller has delivered a positive outlook on profit growth. We're now joined by Andrea Felsted, opinion columnist at Bloomberg. Andrea, thank you for joining us. So, first of all, why is the earnings outlook so positive for Watches of Switzerland?
It's mainly on the US. More than half of Watches of Switzerland sales now come from the US, and the US is doing really well in terms of luxury because it tends to be correlated to stock markets, and stock markets are still, up to now, going strong.
So with this positive momentum, why would the company be interested in going private?
I guess it's what price it's offered. I mean, for investors, Watches of Switzerland is one of the only ways to play brands like Rolex that are private. You can't buy shares in Rolex, but you can buy shares in Watches of Switzerland, which is a proxy. We don't know who the potential bidder was, but if, say, it's private equity, then you would lose that, as an investor, you would lose that ability to invest in Rolex watches.
So, Andrea, what's the business model? Because I've seen it, of course, at airports. We've all seen it at airports, but they don't get a cut, right? So why would you go to buy through Watches of Switzerland instead of going directly through Rolex?
Well, you can't. I mean, as an investor, you can't buy shares in Rolex because they're private. As a buyer, there's probably not a lot of difference in going to Watches of Switzerland, going to a Rolex boutique. I mean, it just depends what's available. Part of the sort of magic formula of Rolex is that not all the models that you want to buy are available, and you have to go on a wait list.
And what's your take overall on a lot of the luxury sector? We've seen a lot of the new designers coming in, some hits and some misses, Andrea.
That's right. I mean, Chanel has just taken the world by storm. Chanel shows that if you get the product right, if you get the pricing right, luxury still has a pulse. I'm still very sceptical on Gucci. I don't think Demna is the right designer. We've yet to see it really take off. Dior is probably doing okay, but it's paling into comparison with Chanel doing so well. The saving grace really is the US. The wealth effect in the US is boosting luxury. That is making up for disruption in the Middle East and for China, it's going in the right direction, but it's a slow recovery.
Andrea, talk to me about football. I love a bit of football. So you have this great... I was in Italy last week, and by the way, it's like the World Cup is not happening because they didn't even qualify. But you wrote this really nice piece saying the UK economy needs an England World Cup win, and we all hope it's coming home.
Absolutely. I mean, there were some projections yesterday from the Beer and Pub Association that said, lots more pints will be sold on Saturday, if we get through on Wednesday. Now, the other thing is that the tournament has coincided with some warm weather. And while, there are lots of problems with the heat, for many people, it does make them feel better. I mean, last Saturday, lovely weather, really good time for the match. I think Wednesday's got quite good timing. So, it's all going in the right direction for the UK economy. Let's see if England carry on to the finals. If they do, then, happy days for grocers, for pubs, the consumer economy.
Yeah, it's quite exciting. Andrea, thank you so much. I have to say, I've spent so much in just, some of the cans where you have to try and find your team. And so you spend and spend just to make sure that you finally get your team. Andrea Felsted there from Bloomberg, opinion on luxury, and of course, the UK economy. Now, coming up, EU ministers failed to endorse a new Russian sanctions package with some key sticking points. We'll bring you the details, of course, on those negotiations. That's coming up next, and this is Bloomberg. The conversations that matter, the insights you need. This is The Pulse, and I'm Francine Lacqua here in London. Now, EU ambassadors are set to meet today after the bloc failed to endorse a 21st sanctions package against Russia. Well, that leaves the EU now at risk of undermining one of its key tools to restrict the Kremlin's oil revenue. Let's get the latest now with Oliver Crook, our chief Europe correspondent. Good morning, Ollie. So where do things currently stand for European efforts to support Ukraine?
Yeah, absolutely. You had those two meetings yesterday, the first in Brussels from foreign ministers who were assembling here to discuss the 21st sanction package, and of course that coalition of the willing meeting that was held by Macron in Paris. And neither of these meetings really yielded any of the concrete outcomes I think that those who are most supportive of Ukraine would have liked to have seen. For the European foreign ministers, they're getting bogged down into some negotiations about what to do with Russian LNG, what to do with the oil price cap with an Austrian bank also that has exposure over to Russia, and how to sort of move the ball forward with that. But the main issue, Francine, is that the oil price cap, that key instrument of the Europeans in order to try to diminish the revenue that the Russians can get from selling their oil out onto the open markets or the restricted markets, that expires tomorrow if they cannot get a breakthrough. So we understand now that foreign ministers are going to continue to push on that today, but there's no real guarantee that they'll be able to get over the line before tomorrow, something that might be kicked into next week. And again, that's something that is probably not ideal for the Ukrainians, not ideal for the biggest supporters of Ukraine, who feel that the tide is really changing, and that if the Europeans want to capitalize on that, the support of Donald Trump, and of course the stress that the Russians are under, that they really need to move forward with that. In terms of the coalition of the willing, again, not a major breakthrough over in Paris, though we did get this initiative, this idea that the Europeans will pool resources and research in order to build their own sort of sovereign anti-air missiles. So those are two things that we're watching. What Zelensky was really pushing for yesterday, and we heard him again talking about it today, is they want a winter package of Patriot batteries, 300 of them, to put them in position to be able to defend their energy infrastructure going into the winter.
Ollie, so Ukraine also continues to strike Russia's oil infrastructure. Are we seeing much reaction to these attacks?
Yeah, Francine, what's really interesting is obviously you see the reaction on the fossil fuels, and we had a great story out about this yesterday with Javier Blas talking about basically we've seen the price of oil go down over the last couple of weeks thanks to Iran, but what we've seen remain elevated, the prices of diesel, gasoline, and jet fuel, and that is in large part because the Ukrainians are absolutely decimating a lot of the refining capacity over in Russia. You had some more strikes overnight, another refinery that's just on the other side of Crimea that can process 180,000 barrels a day. The Ukrainians Iranians struck that also. So that's why you're not seeing the prices of those refined products come down quite as fast. But Francine, something else we're watching over the last couple of days is the price of wheat. We've seen some strikes by the Ukrainians in the Azov Sea, hitting a bunch of tankers, not just for LNG, not just for fossil fuels, but also some of those dry cargoes. And that has driven the price of wheat higher. So these are things that will potentially restrict the ways in which the Russians can have can generate revenue, but at the same time, Francine, for the rest of the world, will likely contribute to driving inflation.
Ollie, thanks so much. Bloomberg's Oliver Crook there with the latest from Brussels. Meanwhile, Bloomberg also understands that President Trump plans to support a Russia sanctions bill championed by the late Senator Lindsey Graham. Now, the proposed bill would intensify pressure on the Kremlin to end its war in Ukraine, bolstering efforts to punish buyers of Russian oil and gas. Well, let's get more from our executive editor, Chad Thomas. So, Chad, good morning. What do we actually know about the proposed bill?
Well, as is often the case out of the Trump White House, we're getting mixed messages. So we were hearing, our colleagues were hearing from sources that President Trump was going to support the bill. He was then talking publicly late last night and saying that, oh, let's take a look at it. We'll see what we can do. We don't know too many details of what's in the bill. The bill that Senator Graham had put forward several months ago would have been crushing tariffs, secondary tariffs on people who buy Russian energy, which of course would have really choked off the Russian energy. But at this point, we don't know what's in the bill other than that there seems to be an effort to move forward with it also in the Senate, in part as a tribute to Senator Graham.
And Chad, this also comes at a time where the White House is extremely occupied with everything that's happening in the Middle East because of the renewed flare-up with Iran. So where does this, are they distracted? Where does this leave Ukraine?
I think that does put Ukraine very much on the back burner. The question, though, is whether that relationship that we saw budding again between President Zelensky and President Trump at the NATO summit, if that moves forward. President Trump is very much someone who the projects he works on has a lot to do with personal relationships and how he feels about people. And they obviously had a very good meeting at the NATO summit, so some people took that as a positive, but clearly all of the focus is at the moment on Iran.
So at the same time, we've seen Hungary pass a law to try and remove the president, which is a Viktor Orban-aligned president. I mean, how feels very significant.
Well, this is a continued dismantling of the Orban system by the new prime minister. And what this also potentially means for Ukraine is that the new prime minister is far more Ukraine friendly. And the more that he dismantles this system that was in place beforehand, it's probably a positive for Ukraine. Of course, but also watching today in Ukraine, the parliament vote on removing the current prime minister as President Zelensky announced that reshuffle of the government that's coming this week. We still don't know who the new prime minister will be, but we are hearing there's probably going to be someone who's has at least connections to the energy sector because of their concerns about what will happen in the winter with attacks on the energy sector.
And we saw, of course, a coalition of the willing in Paris yesterday. I mean, does that come with money, or is it more of a show of solidarity?
I think it's more of a show of solidarity. There weren't messages out of that really said, here's billions that you can now spend. They talked a bit about anti-ballistic missile systems, but a lot of these discussions are about things that are coming in 3, 4, 5 years' time. Great for the European countries, but what Ukraine says they need is really they need aid now.
Chad, as always, thanks so much for joining us. Chad Thomas, our executive editor for Europe. Now, we're just getting some pictures in, of course, from Bastille Day, because it's July 14th, so happy Bastille Day, everyone. There's a big parade that will come through to the Champs-Élysées in Paris, and you're looking at live pictures there where President Zelensky will also be joining President Macron. Coming up, it's Bloomberg Brief, and this is Bloomberg.